Hey, welcome to the Closing Beat. Happy Monday. Hope you had a great weekend. This is our quick stock market update show where we cover really the good and the bad about the markets. We're financial advisors here at Jazz Wealth, so we just like to do these shows, each day, just try to teach you guys something new maybe, or at least let you know what's going on. We're also playing a game if you want to play along. Over the summer here, if you want to guess the Dow, you can go to that website there, bottom right-hand corner of your screen, and you could take a guess. Last week's winner, Robert L., his money is on the way. He's not an existing customer. We sent him a $100 gift card, so congratulations, Robert. And you can, of course, guess for next week where you think the Dow will close. So hoping to get a customer or two to win. If you're one of our customers, we'll credit your account. It could be your IRA or Roth or your individual account, whatever it may be. If you have an account with us here, we will credit that. If you're not a customer, just send you a gift card. No strings attached. Seriously, no spam or anything. Maybe some of you guys can attest to that. We're not going to even email you to let you know. We'll just talk about it on the show. This week also, if you're one of our customers, on Thursday night, we have a class. We're going to go over the loss statistics of the stock market and then specific asset class performance. I know that's like a whoa, what kind of words are you using there? I'm going to try to break it down into no more than 5 slides. I'm going to try to make graphs and make it sort of so that I can drive my point home in 5 slides, 10 minutes or less, but really share some very detailed statistics in the market to let you know when the markets fall, how long do they take to recover? How much do they recover? How long do you have to sort of suffer or be excited if you like buying those discounts? So we're going to cover that. That's all I have for my homework to offer you today. So let's start with the markets. Basically a flat day, sort of a snoozer of a start to the week. I can almost promise you it will not stay that way for the rest of the week. It's the last week in June. You also have, it's kind of typical market activity for right now with the way we're moving here, but you have the G20 meetings coming up this week, and not only are we looking at the Trump and China President Xi meeting, but we're also going to probably be looking at some Russia talk there as well. I don't know if you saw the Russia warships that moved into Cuba, sort of in response to the U.S. moving some of their weapons overseas, and so already the media is starting to kind of push that as Cuban Missile Crisis all over again. Right now it's just sort of positioning, posturing. I think there'll be some conversation and probably media headlines in the G20 meeting about that. That will be a market mover. You also have 5 Fed members speaking tomorrow. Remember this from before when the markets got a little crazy and every single Fed member spoke all in one week. You remember that? Remember what their mission was and remember why they spoke so much? Well, this week, just tomorrow, actually, we have 5 Fed members speaking. Chairman Powell is included. He'll be speaking tomorrow, a bit mid-morning, I believe. So you have that. In the G20 meeting, you have that trade talk, of course, with the President Xi and everything. I think the markets will be satisfied as long as they both don't leave that meeting with absolutely no progress. Meaning, in other words, unless the discussions just collapse and that's it, then I think the markets will be fine with whatever sort of dog and pony show that they put on, and there'll be some of that, don't worry. If there is no sort of progress made, I think you could fully expect President Trump to put the remaining tariffs on them, and as I've kind of played around with the idea, as the markets have recovered, my sort of belief and thought is that gives Trump more flexibility to put those tariffs on there and not hurt the overall markets too bad. So we'll see, right? We're going to find out later this week. You also have Trump putting sanctions on Iran for shooting down our drone there. They officially signed those today. Didn't really affect the markets much. We didn't have much to go on with that. So we'll see. Bottom line is, if we go over to the charts here, what do you have? At the end of the day, all news aside, all sort of Fed news, tariff news, whatever, at the end of the day, you have a market that rallied sharply off those May declines and took a break, just like we wanted, just like we walked you through every single day. Then we shot higher quickly, right? Because of that Fed meeting last week, we had a pretty good little spike. Again, we're saying now, okay, calm down or pull back. The market would be more than fine to pull back here a few points on the SPY. And nobody would really care. So 290 here, no big deal. Even back towards these lows from that first little drop there, nobody's going to care. As long as we sort of pull back around the 50-day moving average, I don't think you really see anybody panic or, whatever. The trouble with that is, of course, all the news that's coming up later this week. So expect some activity, which will be sort of exciting, right? Normal summertime, slow, quiet moving markets. Expect to see some activity in the middle of that. All right, so we have the S&P hitting new all-time record highs here, and I'm still getting this question a lot and phone calls from people, not customers, just people out there that are kind of looking around saying, hey, the market's hit all-time new highs, but my 401k did not. I noticed that I'm still dragging behind. Does my 401k suck? Or is it, just something? Tell me, Dustin, what's the deal? And we sort of covered this on Friday, so I'm going to repeat this just a little bit. In the S&P 500, yes, we hit new highs, but only a few areas of the market pulled us up to that point. If you're widely diversified in your 401k, meaning you have different areas of the market, you maybe some sector funds in there, or maybe you have some different indices or whatever it may be, then you don't have 100% of everything moving in one direction. The S&P broke to new highs basically because of the defensive stocks, right? We talked last week about the consumer staple stock. The XLP is one way you can look at that. Very strong and has been very supportive of this last rally here in the market. You have healthcare stocks, also new highs, well, at least new yearly highs there. So they've helped support the markets overall. And of course, if you've watched us here for at least the last few days, utilities and REITs. I use a whole mix of ETFs to look at REITs. You can use the ICF or XLRE, whatever you like. FREL is on our list here in the dojo. But you only have those areas of the market really pushing us to new highs. Not to say everything else is doing poorly, but it was still playing catch up. So if you notice your 401k or your IRA, wherever you're at, is not quite to new highs yet, that's actually kind of normal, right? You should see it catching up. But as all these other sectors start to participate, then you get it done, right? The XLC is one of them I'll point out, starting to recover here. This communication services, it's doing okay, but it has yet to get back to highs. It's dragging behind a little bit, so a slower growth there. Industrials, there we go, headed back to highs as well, but not able to really show that momentum that those other sectors that I mentioned a minute ago, your REITs, utilities, and staples and such, they haven't been, industrials haven't been able to show that same type of performance. Because of that, that's a portion of your account that yet to have really grown there. Add to that now, you've got retail selling off today. This is the XRT. You're looking at the very much equal weighted index of the retail stocks, if for lack of a better term there, starting to pull back here as well. So you have this entire area of the market that's nowhere near hitting highs. So if you're heavy in retail, you got a little bit more of a drag. Think of a parachute behind a car. The car is the S&P 500, and some of you have a little parachute. Some of you, if you're in retail and more in this sort of communication services and tech stocks, you got a bigger parachute. You'll get there. I mean, it's not a matter of like you're doing something wrong. It's just the market's sort of spread all over the place right now. If we look at energy, that's another area, very, very weak performer. It's the only sector of the market that is not in an uptrend. It's actually trying to decide at this very moment what it's going to do next, but still in a downtrend overall, although it's rather sloppy. So it's the only sector that's still in a downtrend. If you have a lot of energy stocks, maybe you like buying the dips. Well, you got to be patient, right? It will catch up, but it's going to take a little bit of time, of course. All right, the issue here. You go, okay, well, Dustin, I got my REITs, I got my utilities. Okay, I see those doing well. I get it. The rest of them will catch up at some point, but we have a problem. And the problem is that those sectors that led us higher, let's say healthcare, for example, they led us higher and they're now sort of overbought in the short term, right? You got utilities overbought and overvalued, which we just did a class for this for our customers, so you guys know what I'm talking about. You can't expect these things to rocket higher as they have been. If they take a break, would it not be safe to assume that the markets would take a break as well, right? Unless some other sectors start to carry the weight, which could happen, then you have the leaders potentially taking a break, which means the markets could take a break, which brings us back to the fact that that's okay. Right? We shot up too far too quick, and it's okay if those sectors want to take a break and everything else wants to ease off there. Maybe one little shining light in the mix there, but I think it's okay. So it's sort of, we started at the top, we dug into some individual sectors, and now you understand that your 401ks, your IRAs, they're all fine, right? It's just temporarily as we get into this summertime mess, things are a mess. All right, you got GDX here. We did a video today, posted it earlier. This is the fourth most active ETF in the last 30 days. I think you understand why. I mean, you could see how active it is. The problem is it's also overbought. You can't justify buying this or chasing it here, right? It's sort of really, really tough. And in fact, the gold miners and the junior gold miners, is that GDXJ? I don't really like this ETF, but I think junior gold miners. These two are the most overbought areas of the market right now. So if you take the market as a whole, you break it down into the 11 sectors, and then you break it down into groups inside of those sectors, all of them, to really sort of put the microscope on everything. These two are the most overbought areas of the market, which is fine if you own it, but it's bad if you expect the markets to continue higher. If you expect these things to continue, it's more than likely not going to happen. You know what happens here? Everybody gets excited and they dive in, and that's fine until there's more profit takers than there are buyers. And that's going to happen this week. I don't think, I know that's an opinion, I guess, in this case, but I think it's rather obvious that some point this week there will be more profit takers than there will be buyers. The buyers are going to dry up, and what's going to happen? It's going to cause the GDX to pull back just a little bit. So know that these are the most overbought areas right now, and it's very normal to see that sort of profit taking. If you really dig in deeper, you can go into your medical devices space. I use IHI to check that out. That is the second most overbought area in the market. And then aerospace and defense, I use PPA for that. I don't have it on this list because we just end up with a million symbols there. This is your third most overbought group in the markets there. And I thought it was kind of interesting, if you dig a little deeper, solar. Solar is also very overbought. That sort of rally there just sort of snuck by me. I haven't really looked at that too carefully there. Anyways, that's what you have there as far as overbought areas. So again, I'm hoping to kind of paint this picture to you nice and clear that if the markets pause, it's not necessarily that something's wrong. It could be that the leaders that got us there paused as well or pulled back. It could also be if the markets head higher that those other areas, your tech stocks, your semiconductors, all that stuff started catching up and supported the market to the new round of highs. Add to that maybe some good news out of the G20 meetings, a lot of good news out of the Fed speak tomorrow and the next day. You got a reason for maybe a decent rally there. We'll see. In the S&P 500, you got 63% of the stocks in this index over the 50-day moving average, which is always my blue line when you look at the charts there. Financials, which was the leading sector, mostly supported by REITs, but which was the leading sector with stocks over the 50-day, has now lost the number one spot. It's officially pulled back. Services, broad sector there. Services officially takes over number one. When you say services, think like restaurants, auto dealerships, stores, hotels, things like that. Service stocks, right? So those are really starting to pick up. Could be good news economically, right? If you think that those stocks are starting to do well, maybe we're selling more cars, more people are going to more hotels, we're eating at more restaurants. It would sort of contradict the latest retail sales numbers, but whatever. Just bringing you the news there. Technology, by the way, in third place. The tech stocks are rapidly trying to catch up to that second place, and you can kind of see it there. The XLK, looking at the broad-based tech stocks, almost back to highs, so looking pretty good there. For new 52-week highs, you had 35 of them today, mostly utility stocks. So if you look at utilities, there were most of them in that category. They're just strong, right? Now you know we've covered utilities here already a couple times today. It's one of the stronger areas. So you can understand why those are at new 52-week highs, because they didn't have to do much to get to new 52-week highs. They keep hitting them over and over again. I think he had only 4 new lows today, so not really that big of a deal there. So that's what I have for you on that front. Yeah. Okay. So here we go. As far as, Bitcoin, I don't know if you saw Bitcoin, over 11,000 today, making headlines again. It's up 200% year to date, so Bitcoin doing really well. Recent IPOs, we got Slack hitting new lows here. Apparently, Microsoft said they're going to prohibit their employees from using Slack. So a little bit of bad news, maybe, if that's true. Down 4% on the day. If we look at some of the other recent IPOs, you got Uber. Down a little bit there. Oh, let's see. I'm going to go out, try to soak in all that data. There we go. So Uber down a little bit today, down about 2%. This is really starting to develop its own personality. You know how every stock has its own personality? If not, they do. They're sort of like little pets, right? And some of them are more wild than others. Some of them are sort of unpredictable day to day, but more predictable in the long term. And some of them are like great day trading stocks. You could just rely on them to trend and trend and trend on a daily basis. Well, Uber, a little sloppy, as most IPOs are. You can see a lot of gaps in there as people are trying to figure out what they want to do with the stock. Notice now over the last couple of weeks, it's slowing down. there's a more consistent trading range. The excitement, the hype and everything is starting to wear off into the first lockup expiration, which still we got a ways to go. So anyways, just thought I'd point that out. It's starting to really behave like a normal active stock, I should say. All right, Beyond Meat's down 8.5% here. That's down $60 in just the last 5 days. You want to talk about a wild personality, right? You're up here at 200, now you're back down to 140. $60. That's crazy. Down 8.5% all in one day. I recently, last week actually, was just in Ohio, and every restaurant, right? I'm not from there. I didn't cook my own meals. Went out to eat for every single meal. Every restaurant that we went to in like the Cleveland area, downtown, all the way to Sandusky, every one of them had either Beyond Meats as an option or Impossible Burger. Most of them had Impossible Burger, and when you would ask for it, I was going to try it. When you ask them for it, they don't have it. They're out, completely sold out. They don't know when they're going to get any more. So gives you a feel for how like excited people are over this here. Anyways, a couple other things, and I'll take your questions if you have any. You've got tomorrow's earnings. You got FedEx. There we go. Coming out with, let's just back this up a little bit. There you go. FedEx a little bit lower on the day today. They got earnings coming out. This is sort of a tough one. It's not a big gapping stock, meaning there's not usually a large reaction after earnings. The average gap is 1/3%. They beat on earnings and they beat on revenue about 60% of the time, and less than 50% of the time is the stock positive when they report earnings. So if you like a discount, you're sort of hoping the odds play in your favor and the stock gaps down a little bit more for you. So we'll see what happens there. There's only a couple others. You got home builder numbers coming out tomorrow as well. And last time the home builders missed their expectations, the market lost 2%. That was a really bad day. Not saying it was because of that. It just happened to coincide. Anyways, you got Lennar coming out with earnings. Little different story here. They almost always beat on earnings and almost always beat on revenue. This is a more active stock. The average gap for this one is positive 1.8%. So know that this could be one. See, like over here is the last earnings. This could be one that sort of shocks you to the upside or the downside. It's positive 56% of the time over their entire history, which represents 70 instances, if that helps you. In other words, 70 quarters is how long they've been reporting. The final one, which will probably grab a lot of attention, is Micron, right? This one struggled a little bit, sitting here near lows. They almost never have a positive reaction to earnings. You go back 70 earnings reports, and they're only positive 37% of the time. So again, if you like discounts, that's all. I'm not trying to scare you. I'm just saying if you like discounts, here's one where the odds are it will gap lower. Your average gap is 0.5% to the downside there. Tends to be rather volatile on the first day of its earnings announcement. And again, they're only positive 63% of the time. I'm sorry, they're only positive 37% of the time. So odds are to the downside there, if that helps you out there. Hey, that's all I have for you. We'll take a look at some of your questions if you have any, and then we'll go from there. Cool. The Fed has insured the stock market. Yeah, they've basically said, they took away the word patient from their last meeting there, and that they'll do anything to essentially keep the economy rolling here. So expect to see more of that. I expect to see Powell. It's more of a Q&A session tomorrow. I expect to see that he'll be pressured a little bit on the idea of cutting rates. He's a smart guy, though. He's not going to say anything silly. Financial investor says trade war ending in the future, 1.5 year time frame. So honestly, I hope they don't cut rates. I've shown you the stats on that, gone into that in great detail with customers. It's just not a good thing. In the short term, it's great if you're an active trader. In the long term, it hurts. It's not good unless you like discounts. Ricardo says they shouldn't cut rates. Yeah, I mean, if they're really looking at the data, there's no reason to cut rates, right? It's all speculation at this point. Yep. I agree with you there. Let the market pull back. Let it behave. Quit talking so much. The Fed's always out there talking. That bugs me. I'm not telling them how to do their job. I'm just telling them, don't talk as much. Keep some of that to yourself, man. Cool. Why has Microsoft been a great stock this year? The business doesn't much different than it was in the past few years. It's that transition. Their transition over to the cloud. Basically, the subscription service has been a big focus for Microsoft. It's kind of like what Adobe did. They just beat them to the punch, and I get it. It's a different category and everything. Adobe moved from, I don't know if you guys know or remember, you used to have to buy like Adobe Photoshop as a package or go to the store and get the DVD or the program, right? You used to have to buy Illustrator individually and so on, all the different products. Well, they've slowly moved over to that subscription model, and it worked really, really well when they did it. Microsoft's been doing the same thing. They're on the tail end of it, so it's I believe, almost all integrated at this point. Did some acquisitions earlier this year with, what do you call it? Azure, something like that. So all that's going well. And hey, I mean, it sounds like a boring company, but they've been sort of operating on all cylinders there. Yep. I don't like the Russell being weak. Yep, you're right. M&M saying that the Russell, again, weak. Remember on Friday it was weak. It stood out. Today it stands out today. I don't like that. I think that if you had to pick only one warning sign for the overall economy, right there, Russell 2000. There are so many days where the market's been positive or flat and the Russell's pointed to the downside. A lot of weakness there. Yep. Tesla seeing an uptrend, G20 China, and Tesla did get their waiver, I believe, from tariffs there. So a little bit of good news from Tesla. They're just trying to come out of that downtrend. Just did a video while I was gone last week on how to buy downtrends. Tesla would be a great example of that if you're looking to find an opportunity there without me telling you when to buy. So, Yep. Ricardo's got it. Yep. Transitioning into the cloud business. You named it. Perfect. Do you ever recommend life insurance, either universal or whole, as a savings or investment tool? No. Nope. Never do. And without like making a whole deal out of it, it's because your goal is to invest, not for insurance. If you want insurance, you go get insurance. If you want to invest, you invest. I don't like the fees built into all that. They're just, boy, I could go on and on. So I'll stop there. So that's it. Abdur says his dough is looking great. I love it, man. Keep it up. Can you tell us why the Russell 2000 has a 15-minute delay on price quotes? Me? Like, are you looking in the dojo, or are you saying on your platform? You may not have real-time data on your platform. I couldn't tell you. Tell me what platform you're on, or what's the problem there. I'll help you out. Cool. Not bad. All right, so pretty much a slow start to the week. It will not stay that way. I can promise you that. So we'll be covering it here all week with you. Hope you enjoyed. Hope it's something that you guys find useful. I love the comments, whether they're good or bad. It lets me know like what you guys like, what you guys don't like. I just like covering the markets. I do this every day for our customers, and then every Thursday I do a class for them, and once a month we do a class on the overall stock market, extremely detailed to do that. That's coming up, actually, so we'll be doing that again. You can always see the classes that we're going to do for our customers on our website. You just click on events up at the top. You can also see the portfolios that we manage on there and the descriptions. Think of it as we have our own mutual funds. We build our own funds. We just don't call them mutual funds because we don't offer them to the general public. We don't register them like that. We just build the investments for the customers and then go from there. Thanks, Ricardo. I appreciate it. Well, I will wrap it up here for the day. I hope you guys have a great rest of your day, and we'll be back tomorrow, of course, to do this all over again, hoping for more action and excitingness going into the end of the week. See you then.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.